And now again, we are going to do example 4. It is the reconciliation between profit before taxation and cash generated from operations, where interest is capitalized. So we don't need to exclude interest, accrued expense interest on loan in trade and other payables. Now they say here, Star Bar Limited is a company selling borehole equipment to areas seriously affected by drought in South Africa. Their financial year ends on the 30th of September 2018, and then they gave us information. Extract from the financial statement of Star Bar Limited. We know that the financial year end, as it was specified above, it is the 30th of September 2018. And last year, obviously, will end on 30th of September 2017. They gave us profit after tax for the current year, which is 648,000, and for last year, they gave us inventory for this year, which is 310,000. We are going to use both this year's amount of inventory and last year's amount of inventory, but we are missing depreciation for the current year, even though we have been given depreciation for the previous year. Please note, when it comes to net profit after tax, what is important is this year's net profit after tax. That one we really don't care about it. And when it comes to inventory, we are interested in both. And for depreciation, again, we needed this amount. Last year's amount, again, we're not interested in that. Okay. And then they gave us taxation. They said provisional tax of 115,000 was paid on the 30th of March 2018, and another amount was paid on the 30th of September 2018. They didn't specify how much it was. And they said to you, tax is calculated at 28% on net profit. Okay, tricky. You know that when we prepare our statement, our reconciliation between profit before taxation, and it says it, reconciliation between profit before, and here we've been given what? After. But we are given the tax rate. You need to remember this. Profit before tax is at 100, and the tax will be at the given tax rate. And in this case, the given tax rate is 28, meaning that profit after tax will be at 72. Remember the principle, multiply by what you want, divide by what you have. What is it that we want? We want this, but we have been given that, so we will simply divide this by 72 and multiply it by 100, okay? So we will simply multiply this by 100 over 72 so that we can get profit before tax, because that's what we are looking for, okay? Let us go to our reconciliation note. In our reconciliation note, I will simply start there with profit before taxation and put the workings in brackets for me to get profit after tax, and my profit after tax will be 900,000. Done, just like that. Okay, moving right along. I need depreciation. I also need interest expense, and all those amounts are not given to me. Let me just go back to the question. I'll come back to inventory because I know that I have to use that inventory balance. For now, I'm just going to highlight it. I'll come back to it. Okay. Right now, I'm just looking for depreciation and interest expense. Hopefully, as I read further, it'll give me the information that I need. Oh, and then they gave me the mortgage loan agreement, which will enable me, should enable me to calculate interest. Now, this is a little bit tricky because they're giving me my loan from KB Bank for last year and this year, And then they gave us monthly repayments, including interest, meaning that interest is in there. And then they gave us monthly repayments, excluding interest. So this is just the capital portion. It means that of the 4,166, 2,000 of that is the capital portion, and whatever remains is your interest portion. But note that they said monthly, and we are looking for interest per year. So if I want interest here, so my interest will simply be that 4,166,000, you minus the 2,000. So I'm going to use those two amounts. You minus the 2,000, it'll give you your interest that you have paid that is included in those monthly repayments, which will be 2,166. And I'm going to take that 2,166, multiply that by 12 to get my annual interest on this loan. Okay, I wasn't given any interest, I wasn't given anything, they just gave me those monthly repayments. So I'm just going to use that. Let's just record that immediately. So I'm going to go straight to my reconciliation between profit and tax node, and I'll just put in the interest expense, and I'll take that 4,166 minus 2,000 and whatever remains, which will be 2,166. Take it and multiply it by 12. It'll give me 25,992. Okay, now I have interest. I'm left with one thing only, which is depreciation. That's one thing I'm left with. I'm left with that thing only, which is depreciation. Okay, let me just read further. According to this information here, they are not giving me any depreciation at all. Okay. They're giving me trade and other receivables and payables. And I've seen there, I've got debtors control, creditors control, accrued income, accrued expense, income received in advance, prepaid expense, which is insurance, house income tax, shareholders for dividends. Okay, let me just go to the next page. In the next page, they're simply giving me nothing. Okay, now since the information booklet is not giving me anything, I'm gonna go straight to my reconciliation between profit before tax and changes in working capital, or simply cash generated from operations. They should give me something there that will enable me to calculate depreciation. Let's get straight to it. All right. When I get straight to it, you will note that you were given operating profit before changes in working capital. You are going to take that amount, which is 950,000. You minus 25,000. 992 minus the 900,000. And that should give you depreciation, which is the outstanding balance. And your depreciation amount will be 24,008. That's it. Done. Just like that. All right, let's go to changes in working capital. The first item under changes in working capital will be our inventory. Okay. That one will find it in the first page of our information booklet. As I've said, you realize that our inventory has gone down, which is good news for us because inventory going down means cash inflow. Okay, means that we have sold more stock. And when I take it straight to my changes in working capital, I'm going to have inventory in brackets. I will simply have that 345,000 minus 310,000, which will give me 35,000. You don't put it in brackets. The next item will be changes in working capital, trade and other receivables. For trade and other receivables, I will first highlight the things that I need to include in trade and other receivables. The first one will be debtors control. What will be the second one? Accrued income and prepaid expense. I don't care about SARS income tax because if I include it, I'll have to exclude it anyway. When you add all of those up, they will give us our total for each year. That will be with reference to trade and other receivables. Now, I am simply going to show you calculations quickly. And the trade and other receivables, I will start with debtors control. The next item there will be accrued income. The next item will be prepaid expense. Add them up, they will give us this, and you realize that this year's balance is higher than last year's balance when it comes to trade and other receivables. Cash flow wise, that is bad news, means we lost money. Our debtors, people that owe us, did not pay us. So how do we record it? You're going to have increase in trade and other receivables. In brackets, you'll have that 123,780, you minus 53,660. It'll give us our cash outflow of 70,120. Good. Our next item now will be trade and other payables. Let's check trade and other payables. I will focus on items that I need to include under trade and other payables first. I'll highlight them. The first one will be trade creditors. Remember, you leave out SARS income tax as well as shareholders for dividends or any accrued expense which relates to interest on loan. In this case, we didn't have one. So when you add your trade and other payables, you will get this. Okay. Just to summarize it, like I've summarized trade and other receivables. And the trade and other payables, I will simply start with trade creditors. The next item will be accrued expense for as long as it doesn't relate to interest on loan. And then we're gonna have trade income received in advance. You realize that our trade and other payables has gone up, which is good because it means cash savings for us. We obtain trading stock without actually buying it. Are we actually paying for it? Sorry, without actually paying for it. So we didn't pay our creditors, we saved money, which results in a cash inflow. All right. How do we record it? In cash generated from operations and other, well, reconciliation between profit before taxation and cash generated from operations. I'm going to have increase in trade and other payables in brackets. I will have 115,173 minus 96,780. That'll give me a cash inflow of 18,393. When you add everything that is in that square blue rectangle, it'll simply give you changes in working capital. So how do I get that? I took 35,000, I subtracted that 70,120, and I added 18,393, and it gave me a cash outflow of 16,727. You add that with 950,000, it'll give you cash generated from operations. So when you add these two, they will give you this here, which will be 933,276. Okay. Try this classwork. Just pause for a while. Okay, just pause for a while. Yeah, this must come from the 2020 November exam or probably the supplementary exam from 2020. Okay, just take a look at it. All right. Okay. And then try this out. And for solutions, check out the next video.